this is a good place to start because one theme you'll likely pick up on throughout this, as Martina alluded to, this is a very challenging environment for the global economy and for multinational business planning. It will sound a bit gloomy throughout. So I think good place to start is to talk about some of the opportunities that we see in this really challenging environment. So starting with those, we do see areas of resilient performance. From a geographic perspective, these tend to be concentrated among commodity exporting countries, particularly oil and gas exporters. That's related to our view that commodity and energy prices are likely to remain quite high on average in 2023. We also see some opportunities in certain markets in Latin America, Southeast Asia, India, as well as the GCC. These markets, most of them are still likely to grow a bit more slowly than they have on average for the last several years, but in relative terms, these markets offer more opportunities. We also see still solid demand from higher income consumers, and so there's still some opportunity there in the premium and luxury segments. We see potential for a relatively rapid recovery as policy decisions could drive rapid reversals against some of these global headwinds. So a lot of the outlook that we paint here obviously points to macroeconomic forces that are already underway, but it's often difficult to predict exactly how governments are likely to respond. So there are some areas of upside there. Energy, defense, luxury consumer goods, cost-saving technical solutions and efficiency-enhancing products and services will also likely see some upside, and that relates to the general environment we are in. So obviously energy, Europe is in an energy crisis. We're facing high energy costs globally on the whole. So that's an area that's likely to see greater investment in 2023. Defense, we're in a period of great geopolitical uncertainty and risk. So that's another area that's seeing stronger investment. So it kind of goes with this theme that, again, we're in a challenging environment, but there are always points of opportunity, and those are the areas to focus on next year. With that said, obviously, there are a lot of risks as well. Among those we'll highlight are continued high inflation and the risk that this will put pressure on consumer budgets next year. The risk of persistent high input costs. On balance, we're expecting some easing in input costs next year, but there's still continued upside price risk around energy, commodities, shipping, etc. And we could see some downside scenarios there that bring input costs up again. We see the risk of potentially a more severe global recession than what we're currently forecasting in our base case, which could result potentially from another global financial crisis, which would result in a more severe recession than we're anticipated. A lot of what we're highlighting as risks to the global outlook and generally a challenging picture will increase the risk of political and social instability. And then Europe, just due to the fact that there's an ongoing war in Europe, is a region fraught with risks just due to war-related spillovers and the difficulty of predicting where exactly this war will go. So that kind of gives a high-level assessment of how we see the outlook. Going back a little bit to generally how we assess and look at the global picture through the end of next year. We've been focused for several months now on three key drivers of uncertainty. So obviously there's a lot going on. We're in a period of exceptional instability and uncertainty. But nonetheless, there are quite a few things that we can be certain about. So we're reasonably confident that Chinese growth is going to continue to slow, that the war in Ukraine will continue. Go on down the list. There are actually quite a few things that we can be reasonably confident are going to be the case next year. So we've kind of focused our attention on three areas that we see as dominating the outlook for next year. The first is the future of China's zero COVID strategy. How long will that persist? Exactly how it will evolve over the next year. That obviously has lots of implications, not only for Chinese growth, but for global growth, for commodity prices, for manufacturing activity, go on down the list. The second driver of uncertainty is Europe's energy supply situation. How bad will it get this winter in particular? And what will be the knock-on effects from the ongoing energy crisis in Europe? So that's another key point of uncertainty. And the third is Fed policy and all of the impacts that rising interest rates in the United States have on central bank policy throughout the world, and in turn on FX dynamics and global growth around the world. Looking at those three drivers of uncertainty and how we assess the various scenarios that we see in those categories has led us to the conclusion that the global economy will be in a recession at some point between now and the end of 2023. And we'll talk a little bit more about sort of what are the assumptions there, and then what we mean when we talk about a recession. But here are some of the assumptions around those drivers of uncertainty, as well as a couple of other areas. So first, we think it is likely that China will continue with its zero COVID policy through 2023, possibly beyond, but at least through 2023. And that obviously has a number of implications. It's resulted in a downgrade of our growth forecast for China for next year, and generally paints a slower growth picture. We assume that the US will enter a recession, possibly before the end of the year, and maybe even more likely in Q1 of 2023. We call it a shallow recession. It will certainly not be nearly as deep as the COVID recession or the global financial crisis. Is likely to only last a couple of quarters due to the fact that the US, while facing a number of headwinds, also has some key points of resilience. But nonetheless, the US is a major market. The US going into recession obviously has big impacts for global growth as well. We assume that Europe will likewise be in a recession starting in Q4 of this year. Some markets are likely in a recession already, as well as Q1 of next year, and possibly beyond as well. Obviously, as we highlight kind of the energy supply situation in Europe being a point of uncertainty for the global economy, also is a point of uncertainty for the European outlook, and there's potential for that recession to be quite a bit deeper and longer than the recession experienced in other economies like the US. We assume likewise that the Russia-Ukraine war will last into much of 2023, and that there will be no lifting of sanctions on Russia next year. We assume that global energy prices will be volatile and relatively high, even despite an expected slowdown in global demand, demand growth for energy. And that is obviously a case and a point of debate, and a kind of a key one as we look at the outlook. But there are considerable supply constraints that in our view are likely to keep energy prices quite high. For that reason, among others, we anticipate that inflation will likewise remain quite high next year. It is likely to ease from a peak seen this year, but overall, the average change in consumer prices from 2022 to 2023 is going to continue to be historically high. And that will likewise have impacts on input cost inflation for companies, that companies will continue to see high input cost inflation as well. And then beyond all that, there continue to be many sources of disruption that could affect the outlook for inflation, commodity prices, and demand next year. So there's a lot of risks around this outlook.
Hi, my name is Krista Regani, and I'm Marketing Director here at FrontierView. I'd like to thank you for watching a segment of this webinar. If you'd like access to the full video and our latest insights, data, and research, sign up for a free trial with us today. Simply scan the QR code on the screen.